Everybody, please. Welcome to the first class for 2024 for this legacy program. And the title of this first class is going to be Planning a Successful Tax Year. And our speaker this morning is none other than our own Shamika Smiley. And I'm just going to introduce her, read a bio, let you know a little bit about her, and then you will hear directly from Ms. Smiley. Shamika has been doing tax preparations for about 20 years. She began doing tax preparations in Augusta, Georgia, where she was born and raised, before moving to Charleston, South Carolina. She has a bachelor's degree in accounting and a master's in business. She is highly qualified, and she's also registered with the Internal Revenue Service as a practitioner. She also helps clients with bookkeeping services as well as other business services. She is a high school business teacher, and she has been in the education department for 18 years now. And she teaches various business courses to include personal finance, entrepreneurship, accounting, and graphic design. She has two daughters, and she enjoys spending time with family and friends. She also loves to teach and mentor teenagers, youth, and she also enjoys reading. Please welcome Miss Shamika Smiley.
Thank you, Sister Sybil. Can everybody hear me well?
Yes.
All right. So I am excited about talking with everyone today about planning a successful tax year. Y'all gave me a chuckle listening to the conversation about taxes. So hopefully I answer y'all questions and fears, if you got any fears, and skepticism about taxes. And I did want to kind of answer the question because I heard someone mention it, and it was also asking me before the meeting started, and then I heard it asked again, at what point do I not pay taxes? I thought I was too old. And I wanted to kind of bring it back to that quote, there's two things certain in life, death and taxes. And the purpose of that quote is because you can never age out of paying taxes. So unfortunately, to the person, I can't remember who it was. I think it might have been Miss Montgomery.
Yeah, that's right. That was me.
Yes, ma'am. So you can't age out of paying taxes. However, you can get to a point as long as you're bringing in income that you have not paid taxes on, you're going to continue to pay taxes. So that's why there's no age cap on when you can stop paying taxes. If the only thing that you're receiving is Social Security, and it's probably below about maybe 15, 16,000, that would be the point where you wouldn't have to pay anything. But as long as you got 401ks that you had on your job, that you are having taxes taken out of, as long as you have in other IRA plans, as long as you go get another job or a part-time job, you're going to continue to pay taxes up until the end. So that's to kind of put a dip in that little myth. Unfortunately, that's just the way the system is, and they're not changing it at this point. But today I want to talk to you about planning a successful tax year. Oftentimes we wait until tax season to kind of catch our tax breaks and our deductions and kind of get everything together. And when we talked about what exactly should this session be about, one of the things that they mentioned was, well, how do we get everything back throughout the year without waiting until tax time to figure out what deductions can I have? And so what I want to do today is talk you through how to maximize your tax savings throughout the year so that when it's time to file your taxes, you don't have to worry about whether or not you're going to pay back, whether or not they owe you a big chunk of money, because you've been maximizing everything that you should get throughout the tax year. All right, so in order to do that, first of all, we need to make sure that we answer the question, what exactly does success look like when we're doing successful tax planning? First of all, it starts with organizing your tax documents, whether you do it by paper or whether you do it electronically. And so I want to kind of pose the question, and you can kind of drop in the chat, how do you organize your tax documents? Like, just put in the chat, how do you organize it? What's your best method? Do you use a tax program? Do you use Excel? Do you just have a folder that you put everything in? If you don't want to type in the chat, if you just want to unmute yourself and just tell me how you organize your tax documents, I want to hear from you all on how you get yourself prepared throughout the year.
Well, I have a folder and I have a category on my computer as to different things that I pay out. That's how I organize mine. And
Okay.
at the end of the year, I compile everything and I put them in date groups.
All right. So we got file folders. Let me see if I can pull this chat up. All right, we
So in
got
the
another person that uses file folders. We got someone that uses QuickBooks. Okay. We have someone that uses Excel and e-folders. Okay. Tell us about the e-folders real quick, if you got a minute.
I just put it on a drive. So I
Gotcha.
create a folder structure on whether it's OneDrive or Google Drive.
All right. And we got some more people that use folders. Somebody says bright red folders in Excel with bright red labels. That red is important because red is going to not mix in with everything else, because of course, when you organize your stuff at home, all your folders are yellow. So that's a good idea, LaKanya, to use the bright red folder, because that lets you know that that's your tax stuff. So you can automatically go into that file cabinet and pull out the red folder. Somebody said file folder with compartments. I use anybody else before let's see, I got another one.
Shamika, I just wanted to mention, so with my husband doing construction and so many receipts and having to purchase every day, we make copies of your receipts, they can fade. Original receipts can fade. So we make copies of the receipts once he purchases.
Absolutely. And that's one of the things I was going to mention. When you're organizing your tax document, for those of you, and you may be like me, I don't like paper. It's unfortunately that we do have to have paper. Your pay stubs come in paper, your W-2s come paper, your bank statements come in paper. I myself don't like paper because organizing is not my strong suit. And so what I do is scan all of my stuff, still put them in file folders. But I scan everything and create, just like LaCreta does, e-folders. I create folders on my computer. And so every year there's a folder that says 2023. There's a folder now that says 2024. And inside that folder, I'll start to compile any expenses that I've had, anything I've paid. If I paid medical bills, I'll go ahead and scan that receipt, put it into that folder. If I had any type of other expenses for my business, those things go in that folder. Anything that you think that may or may not be related to your taxes, I would still go ahead and make a copy of it and put an extra copy in your tax folder, so that when you sit down with your tax preparer to go ahead and get your taxes done, you have some things that you may not have been sure about, you can ask your tax preparer about. So organizing is going to be the first key to planning anything. You want to map out or lay out and make sure you have everything organized, so that when you start to plan these things out, it makes it more simplified for you, and you're not kind of all over the place grabbing or forgot where you put this document, or where your last year tax return was at because you forgot to print it, or you forgot to save it, or you forgot to download it. So always try to get yourself organized. That's going to be the starting point of kind of making your year a successful tax year. Now, as we look at what success looks like, the first thing we want to look at is your finances. You really want to take a deep dive into your finances. What income do you have coming in, whether it's from a wage or salary job, whether it's from a contracting job that you have on the side. You want to be able to sit down and plan out for the year. This is how much money I'm making for the year. Because in order to successfully, as we get into figuring out how you're going to deduct and figure out what types of credits and how much taxes you're going to pay for the year, is you want to know up front, what does your money look like for the year? What does your finances look like for the year? If you have a steady job, then that's going to be easy. If you're self-employed, meaning that your income may be inconsistent throughout the year, well, now we probably need to go and take a look at last year's finances. So let's look at what our finances did last year. And again, that's going to require a little bit more extra time for you to go back and look at your last year's tax return. How much money did I make last year? Go back and look at maybe the year before that as well to see, hey, is it consistent? Has there been a little increase? Has it been a decrease? Because we know how the economy fluctuates. And so we want to compare what we're making now with what we made last year and what we made the year before. So you kind of want to do at least a 3-year comparison when you're looking at your finances. The 3 years is kind of going to give you an estimate on what this year's is going to look like. And of course, you can plan to be able to make more money, but we still want to be able to maximize on what we've been doing for the past 3 years. And so when we're tax planning, again, you want to look at your finances. And then, of course, you want to build a plan that's going to allow you to pay the lowest taxes possible, right? Because that's the goal, is to pay the lowest taxes possible. If we know that we're going to be paying taxes until we leave this earth, how do I plan to give the IRS the legally lowest amount possible? And that's my goal for you all, is to teach you how to pay the lowest taxes possible legally. Because that's going to allow you to be able to build financial wealth for you and your family. If you're able to save as much as you can on your side legally, then that means you do now have money that you can invest and put to the side for your children or your grandchildren or your nieces and your nephews, or for yourself for vacations and those types of things. And so that's the goal, is to be tax efficient. So my goal for you today is for you to leave here being tax efficient. And then hopefully, if you have any questions, I can answer those as well. All right, so with our goal being to make you tax efficient, I categorize everyone into kind of like 3 categories. And some of you may fall into 2 categories. Some of you may fall in all 3 categories. But we start with our employees. Those are people who make a wage or a salary. So if you can get paid by the hour, if you get paid a salary, you're considered an employee. So all employees are going to be paying what we call federal taxes. So there's 4 taxes you'll be paying: your federal taxes, your FICA, which consists of Social Security and Medicare, and then of course your South Carolina taxes, or whatever state you live in. If you're not in South Carolina, you'll be paying your state taxes. And so part of tax planning is understanding that there's 4 taxes that's going to be coming out of your paycheck. So what exactly would we be maximizing if we're going to maximize those taxes? Well, we know we can't maximize on FICA because FICA is automatic. There's a 7.65% that's automatically coming out of your check that you cannot change whatsoever. So the only 2 taxes that you can maximize on is your federal taxes and your state taxes. So those are the 2 that we're going to talk about today, is your federal taxes and your state taxes. So those are only 2 that you can maximize on throughout the year, because you cannot change your FICA. And then of course, if you're self-employed or your contractors, you're paying into your federal taxes and your state taxes as well. And then retirees are going to be on the same level as employees, because if you work the job for 20 years or 25 years, whatever the retirement age was, and you're drawing retirement from that job, you are also paying into the federal and the state taxes as well. And you also have a form that you can fill out, which I'm pretty sure you've already filled out when you drew your retirement. But those forms can always be changed anytime throughout the year. And we're going to talk about that so that you know how to go back and maximize on those deductions, refill that form out so that you're saving yourself some money throughout the year. Okay. Any questions so far?
Yes, we have a few in the chat. Let me start off with the first one.
Okay.
1099 filers, we would love to pay throughout the year. How would this be done?
So if you are a 1099 contractor, and I'll explain that for anyone else that may not know, it is pretty much someone that's self-employed, but contractors may not have an actual building or a home office. Most contractors work for someone else. So if you contract a job with, let's just say you're working construction, so you contract out work for different builders around the area. So they're going to give you a 1099. If you made over $600 with them, they're required to give you a 1099, and that's proof of income that you're going to have to claim. And so what you're going to do is pay into your tax system. And I got coming up a little bit later, I'll explain that a little bit more because I actually have a slide on that to show you how you're going to pay into that system. But you're going to pay quarterly into your IRS account. And I'll explain that a little bit more, but that's pretty much what a contractor and self-employed individuals would do.
So we have another question. So it's a tag on to the first one. So for
Mhm.
1099 filers, if we have filed married, can we file separate?
So you can, if you're married, you can choose to married file together, or you can choose to married file separate. I will tell you though, that you do get some tax penalties if you do married filing separate. That's because they would rather you file together. Of course, we know why, because you're putting two incomes together, which means that you're paying more taxes on income together. But there are certain credits that you don't qualify for if you do married filing separate. It's not a lot, but there are certain credits and deductions that you can't take if you do married filing separate. So if you choose that route, I would definitely just kind of make sure you look to see what deductions that you normally file that you would lose if you do married filing separate.
All right. We have another question. What items can I get any deductibles for? I have charitable donations, and that is only validated for taxes for church.
Right, so I got that one coming up. So that kind of brings me to my next slide anyway. So where exactly do we start? So there's two best ways to reduce your taxes legally, and that's through tax deductions and tax credits. So let's talk about tax deductions first. Because they're two different things. So your deductions reduces your adjusted gross income, which in turn reduces the amount of taxes that you make. And so if you, and I'm gonna speak to the people first who work a wage job and make salary, or you work for the hour. And so what happens is the income that you make, based on what your deductions may be, and you're already given a standard deduction. Everybody is given a standard deduction. And we're going to talk about the different deductions. But what the IRS does is they take your income, your gross income, and they subtract the standard deduction. And then that's the amount of money that they're going to tax you on. And so if you look at the little formula I have here, let's just say your income is $50,000 and you get a $10,000 deduction, you're now only taxed on $40,000 of your income instead of being taxed at $50,000. So that's how the deductions work. So the more deductions you have, the lower your tax income becomes. And so the goal is to maximize on those deductions so that not all of that income gets taxed. Because if we're depending on saving money, we want to make sure that we maximize on those deductions. So we're going to talk about the different deductions as well. So if we're trying to decrease the amount of money that we're being taxed on, one of the main things is going to be those itemized deductions. So when somebody mentioned those charitable contributions, your mortgage interest, your medical expenses, that's over 7.5% of your adjusted gross income. So if you have large medical bills, if you pay out of pocket for health insurance, again, those charitable contributions that would include like goodwill or any tithes and offering. Those things you get to deduct as well. So that's where the biggest deductions for most people come from. And that most of it comes from those who own homes. Now it works out during the first half when you own that home and have your 30-year mortgage. Probably the first 15 years is where you're getting the bulk of the interest deduction. If you're in the probably 16 to 30 year end of your mortgage, you're probably now, not probably, but you're on the end of that mortgage where you're paying more principal than interest. So that interest deduction starts to go down depending on what year you are in paying that mortgage. But again, those itemized deductions is going to be what you can use to maximize on your deductions. You also get to, if you pay on student loans. And when we're talking about these deductions, again, these are going to be estimated based on your taxes from the previous year. And I always tell my clients, if we're gonna look at saving you money for the year, let's look at how much deductions you use, how much deductions that you had on your tax return last year. Because if the standard deduction, and let's just say if you're a single person and the standard deduction for you is 13,000 and you own a home, you donate to your church, you donate to Goodwill, and so your deductions end up being 20,000. Okay, well now we can actually take that and get that deduction during the year instead of waiting until tax time to get a chunk back. Because what happens is if you don't take your deductions during the year, you're giving that money, you're paying that money into the IRS, and it's going to sit into their bank until they give you a portion of it back. And so, and rather allowing them to hold on to your money, we would rather you use it to invest in whatever else you need. And so you always want to take a look at, because we're estimating this for the year. That's what you're doing. You're estimating these things for the year so that when you do your tax return, you can determine whether or not you paid too much or you paid too little. So that's the goal, is to figure out whether or not we're going to owe them or they're going to owe us. My goal is for you to not owe them anything. Now, if you get a little bit back, then that's a plus, but we want you to get as much as you can to keep as much as your income that you can throughout the year. And again, that's going to be based on looking at your previous year's tax returns, looking at how much you itemized that previous year. If you're consistently paying a student loan and you're going to be consistently paying it all year long for this year as well, then let's go ahead and take that student loan deduction. If you're a teacher or educator, if you teach college or high school or elementary or any secondary school, if you're an educator, you get to take that $300 credit throughout the year as well. If you have a health savings account, let's look at also deducting that on our W-4 form so that you can get those savings throughout the year. And where exactly would you go to actually figure this thing out? So if you're an employee or you're a retiree, you would go back to your W-4 form, and that's going to be in step 3. Let's see if I can pull it up. I'm going to pull that up for you because I want you to be able to see it. Just a second. Here we go. So if we look at the W-4, and I'm just gonna not go over the whole form, but I just kind of want to show you if you're maximizing on those tax deductions. Step 3 and 4 is where you're going to add those deductions. And so if you go down to step 3, where it says if your total income will be 200,000 or less, then it tells you if you got children under 17, you'll go ahead and take that credit. If you have other dependents that are over 17, you'll multiply that number by the number of dependents and plug that number in. Then you'll add the amounts for your children and other dependents. And then also, you're going to add your other credits there as well. We're going to talk about the credits that you get to include on here as well. But then on step 4 is where you would add your deductions. So you got your deductions here. If you expect to claim deductions other than the standard deduction, and that's on 4B, Then it says to use the deduction worksheet on page 3, which would be all the way at the bottom. So this is where you would compute your deductions here. So that will be on page 3 for you to be able to compute all of your deductions. And so if you go back to your previous year's tax return, look at how much itemized deductions that you claimed, plug that number into your W-2, look on there, see how much student loan interest, add that to it. And so you would add all these things together and plug that into your deduction worksheet so that they can figure that into your adjusted gross income and reduce your taxable income. So any questions about how that would work? Go back to me.
We do have a question in the chat about what kind of investments can they consider to reduce tax payments?
All right, go ahead. I'm sorry, read that to me again.
Yes, so the question was, what kind of investments can they consider to reduce tax payments? And then they also said they typically do their own taxes and they use the 1040A. Is that wise?
So we're talking about taxes and then tax planning. So if you've already gotten to the tax portion, then it's just already based on what you did for the year. So if we're talking about going into 2024 now, planning for next tax season, the investments will be any type of retirement savings. If you invest into your an additional, I know a lot of for those of you that work a wage job, you can also put money into an additional IRA account. So if you get a Roth IRA or traditional IRA, now Roth IRAs are not tax deductible. That's because you're paying taxes on that upfront, but your traditional IRA is tax deductible. But investing into various retirement accounts, your 403Bs, your IRAs, educational plans as well. If you get a 529 for your child, those would be considered tax deductions that you can claim with your taxes that you can get throughout the year. Other types of investments like stocks and bonds, or those are not going to be your tax deduction friendly because you're earning money on those things. So those are going to increase your income, not decrease your income. So we talked about the common deductions for employees and retirees. I want to speak to people who are self-employed and consider contractors as well. Your tax deductions are going to come on the side of your business expenses. And so when you're looking at how do I pay taxes if I'm self-employed, well, it starts with figuring out your adjusted gross income. So that's going to be all of your sales that you've made minus your fixed expenses. And the reason I separated these expenses is because every single month for a self-employed individual, you're going to have some fixed expenses. And that could be anything from rent if you have a building, from insurance if you have to have insurance on your business or your vehicle, if you have employees, if you have a set advertising budget that you spend every month, if you have interest on any business loans that you're paying on, if you have equipment that you purchase, you pay depreciation on, and then of course, if you have utilities. And so to figure out what you would be paying into your tax account will be based on you figuring out every single month, and I do mine monthly instead of weekly, but you want to figure it out monthly how much adjusted gross income or how much net revenue that you have left over. So you'll take how much money that you made for the month, subtract out those expenses, and then what you have left over. Then you can go and look at that tax table to determine how much taxes that you need to pay based on that income. And then what I normally tell my clients to do is most people pay quarterly, so you can set that monthly amount to the side. If you choose to pay monthly, you can, but you're not required to pay monthly. Most self-employed individuals are required to pay quarterly. So if you want to pay monthly, you can, and you would just go directly into, and I have a slide at the end that I'll show you where to go to pay this money, but you can pay into your tax account monthly or quarterly based on your net revenue. And that's what you would pay taxes on. And again, there's a tax table that's going to tell you if I made $2,000 this month and I'm married, filing joint, there's a tax table that tells you how much tax percentage you have to pay based on that amount. And so that's how you, if you're self-employed or a contractor, that's how you would determine what amount of taxes that you would pay. The other expenses would be charitable contributions, and these wouldn't be something that you would probably include monthly, just because these are things that could fluctuate. If it's something that you do consistently, they can be considered monthly deductions for self-employed contractors. Like if you give a set amount of charitable contributions every month, then you can include that with your expenses that you subtract. If you regularly contribute to a retirement, and when I say regularly, I mean consistently monthly contribute the same amount every month, then you can take those expenses and include them with your fixed expenses and subtract them from your revenue to get your net revenue. But if you have any expenses that are not something that you pay into regularly, then I definitely want to include it in your fixed expenses that you're going to be paying taxes on, just because at tax time you are still going to be able to write those expenses off. You just don't want to overpay the IRS based on your income. So some of these I would hold off on paying, on subtracting from your income until tax time, unless it's consistently something you pay every single month. Like if you travel monthly and it's around the same every single month, then that will be included with your fixed expenses that you can now subtract from your income. Any questions for self-employed or contractors?
I do have a few questions in the chat.
Okay.
So one of them, and it's slightly off key on what you were just discussing with contractors and self-employed, but the question was, why am I not able to file head of household? I am the homeowner and I have all the expenses, no dependents.
So your filing status is based on a few things. If you have a dependent, you're able to file head of household if you are the one that own the home or live in that home and maintain that home yourself. So if you kind of like have a bunch of adults living together, only one person can be considered head of household if they have dependents that they're claiming. But every adult in the household can't claim head of that household. There can only be one head of household. So if it's just you and your dependents, you can file head of household. If you're single with no children, you cannot absolutely file head of household. You have to have dependents in order to file head of household. So that's one requirement. And then again, if there's multiple adults living in the home, and we're talking people that are not married, but if there's multiple adults living in the home, only one person can file head of household. And that's the person that's maintaining that home and has a dependent to be able to claim head of household. And what was the second part of that question?
Yeah, that was it in summary. They didn't have any dependents.
Gotcha. Okay.
I just wanted to understand why they couldn't file.
Got you. Okay. All right.
Where is the
Anybody have a
amount I
question?
have to pay?
You had another question? Okay. So, so those are your deductions. Again, your deductions are, is going to be, taking your income taking those deductions, subtracting it from your income so that you can decrease your adjusted gross income. Your goal for this year is to decrease your adjusted gross income, the amount of income that's being taxed. So in order to do that, whether you're a wage employee or you're a self-employed, you want to make sure you go back, update your W-4 form, look at your previous year's tax return, figure out how much itemized deductions that you claimed last year and the year before. Most of your amounts should be similar, so that you can go back and fill out your W-4 form and get your deductions throughout the year instead of waiting until tax time. And then the same thing with our self-employed individuals and contractors. Your goal for this year is to take your net income, and this is going to be a little bit more organizing on your part because you have to keep track of your income and your expenses. Someone mentioned that they use QuickBooks, which is a really good system. I use that as well. It helps you keep up with your expenses and your income as well, and also connects to your bank account if you have a business account as well. But you'll take your net revenue that you make, your gross revenue that you make, subtract out those monthly expenses, and that's going to determine what your net revenue would be that you would pay taxes on monthly. And then I'll show you at the end where you would put that money or how you would pay those taxes into the tax system. So we
Shamika,
talked about-
before you move on from the business
Okay.
filers, there's a question about, would leasing an automobile be recommended if it's used for business?
Yes, you can write off your the lease on your automobile. If it's used 100% for business, if you only have one vehicle that you use for personal and business, you can't 100% write it off. So unless you bought a separate vehicle, you'll have to kind of do a percentage based on that vehicle use. But yes, you can definitely use a leased vehicle for business.
Okay, thanks.
So the tax deductions was one way to save throughout the year. The other one is going to be tax credits. So the tax credits are going to be the thing that's subtracted from your tax bill. So if we're looking at our deductions is going to determine how much money they're going to tax us on. Credits come into play. That's going to tell us, well, based on how much taxes you have to pay, I earned this credit. So now my tax bill is going to be reduced by the credits that I qualify for. So that's the difference between deductions and credits. Deductions allow you to reduce your income so that you can determine how much taxes you're going to pay. Credits are based on the actual tax bill, meaning after you've deducted your deductions and they say this is how much money we're going to tax and this is the tax you got to pay. Okay, well now I qualify for credits. So based on credits, I can still reduce my tax bill at this point. So that's what credits are going to do. So credits are going to be $1, and credits are based on most of the credit. There are some non-refundable credits, and I'll talk about that in a little bit. But your tax credits give you dollar for dollar reduction in total taxes owed. So for example, if your tax liability, meaning your tax bill is $3,500, and you have children, you have a child under 17, which means that that child qualifies you for child tax credit, which is $2,000, you now only owe $1,500 because you got a $2,000 credit. And that the child tax credit is $1 for dollar. So that $2,000 is literally subtracted from your tax liability. And again, these are things that you can claim throughout the year. If you're a W-2 or wage employee, you can claim your child tax credit throughout the year. You can claim your earned income credit. You can claim your child care credit. These are things that you can claim throughout the year to save yourself tax liabilities. And so just to kind of look at some of the most common credits, the most popular credits for you to be able to use throughout the year is going to be your earned income credit. There are limitations on earned income credit because it was meant for people whose income is below a certain amount. And so if you're single with one child or married with one child or single with multiple kids, there's an income limitation to that. I want to say it's around 18,000 below. It has to be below 18. I believe it's below 18,000 for single with one. So it's a different amount. It's based on how much money you make. Because it's meant to help those that live below the poverty line. So that's the purpose of the earned income tax credit, because it was meant to give a boost to those that live below the economic poverty line. But that you can claim throughout the year as well. Your child tax credit is for children that are under 17. And I get asked the question a lot, how come I don't get the child tax credit anymore? You'll still get credit for your child. There's a $500 credit that you get for children under 24, but you don't get the child tax credit because they're not considered a child anymore if you're over the age of 17. And so that $2,000 fades out once that child turns 17. And as long as they're 17 on December the 31st, then you're able to get that credit. But once they turn 18, you've already received that credit for them the previous year. All right. The child dependent care credit, you can claim that throughout the year as well if they're under 13. If you're investing to traditional IRA, you can get a credit for that as well. And then you can also, if you have a child in college, you can get your education credits for that child while they're still in college as well. And so these are some of the credits that you can, again, back to that W-4, step 3 that has your credits on there. You would go to your tax return, just like we did with our deductions, look and see what credits you apply, what credits that you had on your tax return for the previous year, so that you can take those credits and get those credits throughout the year. The goal again is to maximize your taxes throughout the year instead of waiting till tax time. So that's the goal of taking your credits during the year, taking your deductions, because the more income that you're saving yourself through the year, again, the better you are to have more money left over to be able to save and invest and put towards retirement for yourself, again, vacations, or save for your children, college, and those types of things. So that's the point of not waiting until tax time to claim all of your credits and your deductions. Some other deductions some other credits that you can get would also be the residential energy credit. And these are going to be the popular ones that you can use at tax time. Most of these I wouldn't recommend you try to claim these throughout the year, just because you're only given so much residential energy credit. And that's also the tax law just changed on what types of residential energy credits that you qualify for. And so that's one of the things that I would wait. Same thing with the motor vehicle credit. If you bought an electric vehicle, the tax law changes on how much you qualify for. So those are things that you can get a credit for. But again, I would wait until tax time for those particular credits. But I wanted to mention them just because if you fix on your house throughout the year for energy, and when we say energy credit, we're talking about energy efficient types of materials. So if you put a new roof on your home that was an energy efficient type of roof, or you put new windows in that was energy efficient windows, energy efficient doors, just make sure you look for those little energy efficient stickers that's on your different types of equipment and that you buy, or the things that you fix your home up with. Just make sure that you're buying the things that's going to save you a little bit of money on your taxes. But those are some things as well. And then if you buy a home for the first time, as you're planning for the year, make sure you put that paperwork to the side as well, because there's a first time home buyer credit that you would qualify for when you do your taxes. So this wouldn't be something I would try to claim throughout the year as well. But the ones on the left, like your education, your IRAs, your child care, your child tax, those are going to be the credits that you as an employee or retiree, you can go back to your W-4. If you're not claiming those credits and you qualify for them throughout the year, you can go back to your W-4 form and add those credits in there so that you can reduce your tax liability. Oh, wait, let me go back. Sorry about that. All right, and so that brings me to the next slide, which is for those of you who are self-employed or contractors, how do you pay taxes if you're an independent contractor or you're self-employed? So we talked about what type of, how you would figure out how much to pay. Once you figure that out, exactly where do you go to pay it? So if you go to the IRS website, irs.gov/payments, you're going to go ahead, if you have never logged in, you're going to have to create yourself an account for your business. Otherwise, you can just file it under your Social Security number. If you have an EIN number for your business, it would be better to create one for your business instead of using your Social Security number. But it's up to you whether or not you want to do it that way. But if you're just keeping everything up under the business, this is where you would go to make payments. You can pay it online through the IRS website. Once you create your account, you can also go to these other stores to make those payments as well. They've kind of centralized the payment system for you to be able to go to these different stores and just make payments into your tax account. Any questions from my independent contractors or self-employed?
We have one question about mileage. What is the best way for keeping up with mileage travel for business?
So when you're traveling for business, there's several things. There's some apps that you can use to keep up with your mileage, or you can keep track of it yourself. Just keep a ledger and just write down, keep track of what places that you go for business, so that when you get back, you can go ahead and write down the mileage round trip from your home to that place of business and back. But again, they do have apps to keep up with that stuff. If you travel a lot, an app would be best. If you don't travel a lot, then just kind of keep a ledger with a list of each business trip and the location of that trip, so that if you don't have time to compute the mileage, you can at least go back and do it at the end of the month. Hopefully you're keeping up with it monthly anyway, but you can kind of do it at the end of the month. Backtrack yourself to figure out how much mileage by just looking up the round trip mileage. And when you're paying your taxes at the end of the year, you can go onto this website to pull up a statement of how much you paid into your tax account, so that when you do your taxes, you can then add your tax payments to your tax return. So that's how this would work for my self-employed or contractors. So as for tax planning, we always have to make mention that, of course, things happen in life. There's life events that happen, and so you always want to do reviews of your tax plan, because if you buy a home, there's going to be some tax consequences of it, tax benefits really, of purchasing a home, because you get to write off the taxes on it, the interest on it. If you buy a rental home, there's going to be some tax benefits, but also some tax consequences, because now you're having, you bought a rental home, that means you're renting it out to someone. So you now have extra income coming in, which could put you in another income bracket. So you want to sit down again, and when you review your tax plan and you buy a home or you buy a rental home, definitely if you're buying a rental home, sit down and go back through your tax plan and see what that extra income is now going to, what tax bracket it might put you in, or what's it going to do for you tax wise, because you may have to then again save some money to the side, or go ahead and pay into your tax system based on the income and expenses Same way you would be a self-contractor. If you're renting a home, it works the same way as if you were self-employed. You can take that income, subtract out your expenses that you're paying on that home for the month, and then you would pay taxes on what's left over on that portion of it. And again, you can make that same tax payment into your IRS account, just like a self-employed person would as well. Other life events, if you plan on getting married, that's going to change your tax plan. So you want to kind of go back and look at what happens when we put two incomes together. Are we bringing two families together? Or should we do married filing separate until we figure things out? So that's something that you want to review as well. If you go through a divorce, that means now you're splitting things up. Do we do married filing separate? If the divorce is not final, are we still filing together? So those are also some things you want to think about as well, and go back and review. If you get a new job, that means you're filling out a new W-4 form. If you lose your job, what would be the tax consequences, not consequences, but what would be the tax implications of that as well? So have a new kid, if you got a kid going to college. So all of these life events should also make you go back and review your tax plan. What's going to happen if I plan on retiring this year? What's going to happen with my income? Do I need to go back? If I'm retiring this year, I want to make sure I sit down with my tax person, or if I do my taxes myself and I'm retiring, sit down and make sure you go through your W-4 form thoroughly so that you are maximizing and that you're not giving away a good portion of your retirement income. Because we all know that your retirement check is only half of what you're making when you were working. And then the same thing if you're widowed, that's going to change your tax plan as well. So all of these are significant life events that will warrant you going back and looking at your tax plan, and then of course making the changes that you need. Any questions about certain life events that anybody might have a question on? All right, and so just kind of looking ahead, you always want to make sure that you view your IRS account online. Is everybody that has a Social Security number has an IRS account. You may have never been on the IRS website to look at it, but remember that they can tell you how much money you're going to get back at retirement. That means they're keeping track of every dollar that you've made since you first started working. So if you've been working since you was 14 years old, like some of us have, even if you was working part-time, if you've been working since a teenager, you can be able to track, even on the Social Security website, you can go back and track the money that you've made. So you want to go to the IRS website and just look at your account, because they can tell you, even if you can't find your previous year's tax returns, you can go on there and look up your previous year's tax returns on your IRS account. You can look at your previous year's deductions. You can look at your previous year's credits to see how much credits I've taken, how much deductions that I've written off. So you can look those up online on your IRS account as well. And then of course, one of the things I want to mention is a bank account. You want to make sure you get a bank account, because keeping your money in the stock drawer is not healthy financially. So you want to make sure in this day and age that you have a bank account. Number one, because that's where your money is safer. Not only that, you're connected to be able to get, if you file your taxes, they're mandated that your taxes be filed electronically. And then they're going to send you a check if they owe you money. They're not sending cash. So it's just real good that you have a bank account in this day and age. The next thing I would just want to go over quickly before I finish up is the W-4 forms that I told you about, that you're going to use to adjust your deductions and your credits. The W-4 form is going to be used to adjust your federal credits. And then of course the South Carolina W-4 form is going to be used to adjust your state credits. And if you're in Georgia or any other state, it'll be called the Georgia 4 or Georgia, I think it's the Georgia W4, Georgia 4. The same thing with the other states as well. But again, that step 3 and 4 is going to be crucial for those of you that want to save throughout the year. Go back and get those credits. Go back and look at your tax account if you need to go online to look at it, or if you need to pull up your last 2 years worth of tax returns to kind of look at what you've been claiming. And if you haven't been claiming it, then let's go ahead and figure out from this tax, the taxes that you're about to do right now, go ahead and compute how much you're going to be doing for this year based on your current year tax return. So you can base it off the current one that you're about to do now if you haven't done that one already. So any questions about the form itself? All right, the last couple of things is just the tax rate. It's a lot to the tax rate. There's a tax rate for people who are single. There's a tax rate for people who are married. There's a tax rate for people who file head of household. And there's a tax rate if you file separately. So this is the 2023 tax rate. Compared to the tax rate now, it has increased, and that's because if we look at the economy, I don't know if you watch the news like myself, but Biden's economy is doing very well. And because of that, that means the tax schedule is going up. And if you watch the news, you see they just did a 9.5 billion package to help overseas and whatnot. That falls on us a little bit as well. And so there's been like a 5,000, the tax bracket kind of increased by about 5,000 or 6,000. And so where it used to be people that made from 0 to 11,000 paid no taxes, now they dropped it down to 0 to 6. So if you're married, if you're single or you're married filing separate, this is what your tax bracket would look like. And I'm just kind of pointing out a few, but if you're anywhere from 17,000 to 53,000, which is the average American, your tax rate is around 12%. So that means that before any deductions, they're assuming that you're paying 12% taxes on that 53,000, or anywhere between 17,000 to 53,000. Now, what you're going to do is go back and adjust it because you get those deductions and those credits. And so you're going to subtract your deductions and your credits to reduce the amount that you're going to pay that 12% on. And so what's going to happen is if your income is 53,000, you're going to have some deductions. And let's just say your deductions is 10,000, you're going to be taxed on that 12% is only going to be taxed on 43,000 instead of the 53,000, because you're going to take your tax plan and save yourself some money throughout the year. So that's the goal, to make you tax efficient this year. And so that was just the single and married filing separate house tax bracket. This is the one for head of household. Again, remember, the only ones that can file head of household is those that are claiming dependents. And so that's what your tax bracket would look like.
Hello, can you hear me?
Yes.
I think I had a question about bereavement and crisis. I donated those things. Will that be a deductible for me?
Was it donated to an organization?
No, just individuals.
So the max that you could give to individuals is 500. So anything over that, you can't deduct as a charitable donation. Anything over that would need to be a 501c3 type of organization or a nonprofit organization. So if you're giving cash to individuals or writing checks to people or even helping family members, anything over 500, you can't deduct unless it's a legit nonprofit or 501c3.
You said over 500?
Yes, ma'am.
Because there are different situations. You know.
It wouldn't matter. You can add them all together. If it's over 500 total, you still wouldn't be able to write it off.
Okay, thank you so very much.
You're welcome.
We
And then
had,
this is the tax bracket for the married filing joint. Just want to kind of let you look at your tax brackets real quick. Go ahead. You had a question?
Yeah, we have two last questions, because I know we're a little over time. So one question was, does home improvement qualify for anything? And then another question, are washer and dryers considered energy efficient? And does that work?
So washers and dryers does not count anymore, and that's one of the things that changed with the new tax law changes. Um, you can't write off your energy efficient equipment that's in your homes. It's only limited to your hot water heater, your windows, your doors, and your roof. Anything else inside of your home, you just add whatever you spend, you just add it to the value of your home now. So no washer, dryer, no stove, refrigerator, none of those things qualify anymore. And then these are just some recent tax law changes. Y'all probably heard the 1099. If you get a bunch of money through Cash App for your business, they're gonna start reporting that. Starting this year, they was trying to start it next year. But last year, they didn't start it last year. So if you get money through Zelle or Cash App or PayPal, they're gonna start sending you 1099-Ks to report the amount of money that you're getting for that. So just be mindful for those of you that run a business and that use those third-party apps or third-party platforms for payments. The standard deduction for your mileage is going up. This is for people that drive trucks or that work a job, that drive a vehicle and able to write off your mileage. The mileage rate went up 3 cents. The home energy credit change, I was just telling you about that. They took a lot of stuff out of it now. So again, it's just your doors, your windows, your roof, and did I miss anything? The doors, the windows, the roof, and your hot water heater, and your insulation. You can do insulation as well. And then of course, if you buy electric vehicle, that's always been a credit. Some things changed on that, but if you got a clean or commercial vehicle, you can read up on that. And then a couple of changes in retirement is the last thing that changed. For people under 59 and a half, you can now take a penalty-free early withdrawal from your IRA. For emergencies, you can take up to $1,000 without paying that extra penalty. And then of course, if it was domestic abuse, you can take up to 10,000 out. If you have a 529, you can now roll that over to a tax-free Roth IRA. There is a cap on that as well. And then there's a new student loan relief that they just came out with through your employer. If you're paying on a student loan, your employer now can match that student loan and put into your retirement. Not quite sure if employers are geared to kind of give you that, just depends on where you're working. But if you are paying on student loan and want some student loan relief, that would be a question you can ask your HR. Are they participating in Secure 2.0 is the name of the new Biden's bill, Secure 2.0, and that's for student loan relief. And that was it. I did answer this question at the beginning. At what age can you stop paying taxes? If you were late for it, there's no age cap on paying taxes. As long as you have income coming in, you're going to be paying taxes on that as well. So there's no age cap with paying taxes. You're going to be paying taxes until you leave this earth, unless you're only receiving Social Security less than like 16,000, and that's your only source of income. Outside of that, as long as you're drawing retirement, you're going to be paying taxes on it. And I'll take any questions if anybody have any.
There's one in the chat that says, does it matter what type of car you can lease for business?
It does matter what kind of car you can lease, and it's based on the weight of the vehicle, because what they don't want is people buying these big old large vehicles, recreational type vehicles, and using those for business. So there's a weight limit on it. You definitely would need to do some research on vehicles. If it's a small car or SUV, Those are like your typical business vehicles. If you're thinking about like a larger truck, flatbed truck, or something bigger, definitely do the research on the weight limit as far as writing it off for business. And what type of business you're using it for as well.
Mhm. Shamika, this is in the chat as well. Can you put up your contact information for anybody that may want to reach out to you afterwards?
Yes, I can do that. Let me put that back up.
Okay.
There we go. So there's my contact information. Hopefully I helped you all with your tax questions today. If you have any more tax questions, I'm more than welcome to send me an email. I do free consultations as well. You can go to my website and make an appointment to sign up for a free consultation. I do 30-minute consultations for free. And of course, you can email if you have any questions as well.
Okay, well, thank you, Shamika Smalley. That was an excellent job. I'm sure most of you guys would agree. It was very informative, gave us good information, and we should at least give us a starting point as to where we should be planning and starting our planning for taxes for 2024. So thank you very much. Great job. Awesome, awesome, awesome. I learned a lot of information, and I know everybody else on here learned something as well. So thank you very much.
You're welcome.
And I
Ditto,
want to
ditto,
thank,
ditto.
yes,
You're learning a lot.
yes. And I want to thank all of you for joining in as well. I'm sure that you guys had an interest in this topic, and I'm sure everybody learned at least something that they didn't know. So thank you for joining in. We definitely appreciate your time. And we feel that this is a time that was used wisely because we were able to get some information to help all of us with our personal finances. So let me remind you that our legacy program, we will be doing classes quarterly. Please stay tuned for additional information on our next upcoming class. One of our goals is to optimize your financial potential. So please stay tuned. Please get into those classes, invite other people to come to the classes that we will have throughout this coming year. This class was recorded, so it's also on our YouTube page, which is My Legacy Program. You can follow us on YouTube and on Facebook for additional information, but we thank you all for participating and for joining us. And again, we want to thank Shamika Smalley for the great information, the great presentation, and if you guys need to reach out to her, please do so. Thank you so much, and y'all have a great Saturday and have a great weekend. And we're signing off.